Welcome, Ivan, session 3, retire into the stock market, January 15th, 2022. How are you?
I'm great, thank you. How are you?
Take a little break there. I'm doing good. Welcome back. Do you have some questions for me today, this week?
I do, yes.
Which are?
First question is, when you listen to the radio while I'm driving, it says, oh, today, for example, NASDAQ is down 20 points or the Dow is up 12 points or the S&P. What exactly does that mean? I know it means the stock's going up and down, but point-wise, I don't understand. I guess that tells you how much has gone up or how much has gone down, but is 1 point a lot? Is 100 points a lot? Is 10 points a lot?
Think of it like a gauge. Think of it like a gauge. It's kind of telling you the temperature of the market. That is telling you the tone, the market of business. The market's really up. That means investors are excited. They're buying. The market's really down. That means that investors are, sluggish, or they're selling, or they're negative on the market. Maybe there's some bad news that came in, right? So on the Dow Jones, whether it's the Dow Jones or the S&P or the NASDAQ, most of the time, it's not very, it doesn't matter, because most of the time it's down like 0.5% or up 0.5%. So if the Dow is 36,000, which it is, if you look behind me, it just went below 36,000, which is kind of like a new high. It recently hit 36,000. So we're sort of like in the midst of a bull market. Okay, it's going up sort of in a trend over the last few years. But if it's down 1% or up 1% at 36,000, how many points is that?
1% of 36,000.
Mm-hmm. What's 10%?
I'm sorry.
What's 10%?
10% of 36,000 is 3,600.
Right, and then drop another digit to 1%.
3.6%. No,
360.
360. Yes. Okay.
So we have 36,000. Okay. 1% is 360 points. So what I mean by it doesn't matter is that sometimes it doesn't matter. Is that oftentimes the market is down like 100, up 100, and they'll say it's down or up. It's not really down or up, because not even 1%. So for me, if it's up 1% plus 1%, which is 360 on the Dow at this point, then it's like an up day. It's positive. It's up market up. Okay. But if it's up 10 or 20 or 50 or 100, it doesn't really matter at all.
So they don't, okay, but they should more accurately, instead of saying, oh, it's up 360 points, they should give you a percent, up 1%.
The percent's there, but the reason why they don't say percent, they say points, is because they're selling ad dollars on the news. So they're appealing to like this low mentality of people watching the news, and they don't know what 2% is. So but they can get their mind wrapped around 100 points, So again, unless it's up or down at least 1%, it's not really up or down. It's just, they're just giving out numbers. They're just kind of like telling you the news, but it's not really meaningful.
Right.
Sometimes they'll say, hang on. Sometimes they'll say it's up 50 points. If the Dow Jones is up 50 points, it's actually flat. If it's less than 1%, it's really flat. There's no change. Okay. Don't get excited if it's down 100 points, 200 points. Look, it's down 200 points behind me. But my Apple was up. But my AMD stock was up. So my Netflix was up. Look at Netflix.
I can see it, yeah.
The Netflix was up. So what, doesn't matter to me. So what you're looking for when they say numbers is two things. One, if it's down like 500 points or 1,000 points, 500, I'm gonna say 800 or 1,000 points. That means the market's really dumping. Somebody massive selling, 500 points, 1,000 points, and you'll see that like in a correction or like in just an off day, China shot a missile at the wrong place, whatever. So the market's down, where invading this country, just like world news or catastrophes will do that. On the positive note, if we're getting good numbers from corporations, good profits, if we're getting more customers, better products, a good environment for business, the market can be up 500 points, 600 points, and that's a nice move up. And that you want to watch for. In that case, what I would do, I would go with the trend. I would buy in those positive times because it's showing you a trend. Okay. Whereas if it's going down, I'd be cautious to buy because it's showing a negative trend. Okay. Now, since I said that, I have to tell you the other side of that. If the trend has gone down for a while, that's different because now we're looking for a bottom of the market. Okay. So you understand? So now we can buy on a downtrend if it's gone down for a while. On the other side, if the stock market has gone up for a while, a long time, we can look, if we're trading, we can look to sell because now we have a nice profit. It's going up. Maybe we shouldn't buy. Maybe it's so high, it might come down. So you have to look at both sides. Okay. Make sense?
Yes. Mm-hmm.
But back on your point, if the NASDAQ or the S&P or the Dow Jones is up or down, see if it's more than 1%. If it's not, you can honestly ignore it. It's flat.
Okay.
It's like saying it's zero. The NASDAQ, I think, is 14,000. So that 1% of 14,000 is 140. So a NASDAQ, a common move, the NASDAQ would be up 60 points, which is not even 0.5%, which is nothing.
Okay.
That'll happen at 6:30 a.m. on Monday when the market opens for Pacific time. And that might sound bullish, but it's really just flat.
Got it. So that
if it's down 50 points, it doesn't matter. It's just flat.
Okay. So
look for 1 to 2%. Here, look for 1 to 2% for a meaningful result.
1 to 2% for what? I'm sorry.
A meaningful result.
Meaningful. Okay.
Does that answer your question?
Almost. Yes.
But you had another point you were going to make. Go ahead.
Yeah, well, regarding the same question. So the 1%, the screen behind you says Dow Jones 35,911, close to 3,600. Is that
1,000?
Yeah, 36,000.
36,000.
Right.
Don't say 3,600.
No, you're right. I'm sorry. Yeah, 36.
When I started in the market back in '88, the Dow Jones was, I'm going to say, 6,000. So yeah, it has moved up a little bit since then.
1988.
But the 6 times, yeah, you can check it out.
Okay, that was my next question. What does that number mean? And does that number fluctuate, goes up and down? Now you said back when you started 1988. Wait, when did you start? You said
88.
88. The Dow Jones was 6,000, and today is 36,000.
Yeah.
What does that number mean? 36,000.
Okay, so the Dow Jones is the top. I just call it the top 30 stocks. Now they're not really top 30 stocks. Okay. They're just 30 stocks that they pick to rate the market. Okay, like Nike's on there, Apple's on there. Big companies. Most of them I say are good. Salesforce.com. Some of them I don't like. Like the banks. I don't particularly like the banks. The banks don't do that great over time. That they go in cycles. But the person who's in charge of the Dow Jones is the one who writes the Wall Street Journal. So they're kind of tied into, it's kind of like they're like privileged that they get to put whatever stocks they want on the Dow Jones. It's not done by an algorithm. It's not done by people voting. It's done by one guy or a group of people deciding what stocks they put on there. So it's kind of like
subjective. They just feel whatever they feel
subjective. Like. It's subjective. That's okay. Why the S&P is a better monitor of the overall market because they have 500 companies.
The top
And most-
500.
Yeah, that's how, and the majority of the companies are just basically based on revenue.
Okay.
So it's
Got it.
less subjectivity and it's more numbers. They just barely put Tesla on there, you know, because they started showing a profit. They like to see a profit for the S&P, but they also like to see revenue. So they just barely put Tesla on there. You know, I say it's a little bit late, but since they put Tesla on there, you know, you're going to see the S&P, you know, do better because at least maybe a small amount better because Tesla's on there. Tesla's going to do great. I think they're going to keep on doubling and tripling. If I'm right, that's going to bring the S&P up higher. Okay. So like back on the Dow Jones, these 30 stocks, if they, let's say each go up 1 point, that's going to bring the Dow Jones up another like 500 or 600 points. If they each stock goes up 1 point, for example. I don't know the exact math, but it's related like that.
Okay, so still, what does the 6,000 versus 36,000 mean?
Means that if the stocks were the same, which they're not the same, by the way. And here's the thing you got to understand. The market's not fair per se. They have their own little tricks that they do to make them money, like on Wall Street. And the average investor, like near you, are completely shut out. For example, on the Dow Jones and the S&P, but let's say the Dow Jones, they'll take off the stocks that are doing weak, and they'll put on stocks that are doing strong. So when we say the market's up, in this case, it went up 6 times. It went up 700%. It went up six-fold return in what, 22 years? 32 years? 32 years. The thing about that is some of those stocks that were on the Dow Jones are no longer on. They took them off because they weren't performing. I remember they had Bethlehem Steel on the Dow Jones. They snapped that guy off. Once it didn't make a profit, once it started going down, they took off Bethlehem Steel. They put on whatever, American Express, for example. So in a way, it's cheating because if you have somebody invest in the Dow Jones, let's say privately, and they take those weak stocks off the Dow Jones and put them on, and what they're doing is they're improving their portfolio, right? So unless the investor also improves that portfolio exactly to what they're doing, they're going to be behind the market. Make sense?
Yes.
So they kind of cheat. You know, they take whatever stocks they don't like, they take them off, they put on the stocks they like. You know, who's to know if there's, you know, I mean, that's right away, that's manipulation because there's mutual fund managers who manage, you know, 800 million, for example, pension funds, and their job is to, let's say they cover the Dow Jones, so they have to buy these Dow Jones stocks. So if a stock is coming on the Dow Jones, this is maybe good for you. Those mutual fund managers have to buy that stock. That's their job. They don't decide. They have to buy that stock because they're covering the Dow Jones. They have to sell the one that's going off. So what that means is that stock that's going to go on, that's a buy rating because that stock's going to go up because the moment it goes on the Dow Jones, more people buy it and the stock's going to go up in price. New additions to the Dow Jones, write it down. New additions to the Dow Jones go up in price. So watch out for those additions to Dow Jones and also S&P 500. Put arrow up, go up, and then stocks removed from Dow Jones and S&P. S&P go down. Follow me?
How often do they switch them back and forth? Every day, every week, every month, or
probably every between 12 and 18 months.
Oh, really?
But take off a few stocks and put a few on.
Would you say most of Dow Jones stocks are also in the S&P 500?
Yes, I think they all are.
They all are. Okay.
I think so. Yeah.
Okay.
But like on the S&P, you'll have some smaller companies, and the Dow Jones mostly is the big mamas, big daddies. Okay, so where was I?
Okay, good.
So that's kind of like telling you a little bit about the Dow Jones. Yeah. So if you were in these 30 stocks back in '88, you would have made 6 times your money, but you would have had to keep changing them every time they changed them, right? And they decide beforehand. So by the time, here's the thing, this is how you know it's manipulation. They decide beforehand. So by the time that it goes on the Dow Jones, you'll notice that it has already gone up because people know, they talk,
Right.
So it's almost like, that's how, in a sense, it's not fair, because we're the public. We get the memo at the last day. The person who decides makes these big decisions, they know ahead of time, so they have an advantage. So whatever that's worth.
Right.
It's never going to be completely fair. Big money, control. It's not. It's done from the top. That's why they catch people for insider trading, because they don't like that. But at the same time, you can't stop it.
Right.
Because people have the information. If you work for XYZ, you know what your profit's going to be before you have to announce it to Wall Street.
Right.
So you have the previous information, right? So you know what's going to happen. When those investors get a hold of that information, if it's really great, they're going to buy your stock. If it's awful, they're going to sell your stock.
Right.
So we need to do that information,
Right. Got it. Okay.
Did I cover the Dow Jones and S&P?
Yeah. Are those the two they usually report? They don't say NASDAQ is up, down. It's because that's not. It's just
all three: NASDAQ,
exchange.
Dow Jones, S&P. They all do it.
Okay.
There's talk that we're going to take out the Dow Jones and use the S&P, but people like it so much, and probably they want to do it for a while. But S&P is a better indicator, like I said, because Dow Jones is just really 30 stocks. They don't. It's a small niche.
Got it. So the Dow Jones at 35,911. That's pretty stable. It's not going to drop to okay. I got it.
It's not. Hang on.
It's not going to say 30,000 by next week or something.
It's not stable. No, don't say that. It's not stable. I would say that the market's very delicate. If bad news comes in, it does, it can knock off the market easy 2-3%, 4%, 5%. 5% on the Dow Jones is 1,500 points, 1,700 points. That's like it down a lot, But it won't happen in one day. Usually it happens like over time. So if you see, if I said it was down, if you heard it was down 2%, let's say 700 points, that's one thing. But if it was down, 100 points over the course of a whole month, that's 3,000 points. So that's also negative tone. So you may not notice that, but it's going down slowly over time. 3,000 points, 100 points a day times 30 days, 300 points, 3,000 points. It won't be exactly like that, but the idea is that the trend is down. And then you'll have a trend up also. So watch out for that. So it's you have to pay attention.
Got it.
Okay. But I don't want to say it's stable, because the market's not stable. And the reason why you can say it's stable, and then you have some bad news.
Yeah, I would say stable. That means it's not going to be 36,000 today, and then tomorrow be 12,000. I mean, not that huge of a fluctuation.
A big fluctuation would be like down 1,000 points on the bad news, and a bad week would be like down 5,000 points. That'd be a really bad week.
Okay.
I don't think it would ever go to 12,000. I don't think.
Right.
It could go down to like 19,000 over the course of 18 months in a bear market, for example.
Okay.
It won't happen in a day. It just won't. I say if normally it fluctuates between a couple hundred points. It could go a couple thousand points, let's say, in a month. But stability, is relative. So I just say that it changes by the market conditions. And right now, I say the market's pretty strong. I say, you go ahead and buy those shares right now.
Got it.
They're
Okay.
talking about a correction, a crash. We don't know when that's going to be.
Right.
If you waited, to buy, in every crash, you'd miss a big move to the upside.
Right.
So my teaching is don't wait for a crash. The market's good, get in a good stock. That's why I want to talk about core 10 today. How to create and manage your core 10. The idea of a core 10 is that you're going to buy 10 stocks.
Oh.
You're going to pick out 10 stocks of all the stocks that you want to follow, and you're going to focus on those. And the reason and the point is if you can get good on trading 10 stocks, so you can excel at that, you don't have to worry about 100 stocks or 1,000 stocks. The problem with most investors, and this is a big mistake people make, especially coming into the market, they try to follow 5, 10, 20, 30 stocks, and the portfolio has like 10, 20, 30 stocks. They know nothing about them because they're not focused. They're all over the place. I need to focus on initially 1, 2, 3, 4, 5, and then 10 stocks at a time, and only focus on those because I want you to get good at trading those. I want you to get comfortable. I want you to know the volume. I want you to know their PE, how they feel. Like you said, the market's stable. It's not going to drop to 12,000. No, it won't. And you'll know your stock, what that can drop to, because you're knowledgeable, you're comfortable, and you're experienced in your particular stocks. And that's why you want to have a core 10. Because you can excel at those. Whereas you can't if you were trying to watch 100 stocks or 1,000 stocks, right?
Mm-hmm. Okay.
So write down core 10. Choose a core 10.
Got it.
And today I want to continue with the stock selection criteria. Mm-hmm. We have 10 total. I think we went over 5 or 6. When I talk about all 10. Mm-hmm. We talked about that in session 2. Look at the video. Uh-huh. Okay, you had another question also. Were we done with the Dow Jones?
We are, yes, thank you. That was very helpful. Thank you.
You had another question also.
Yeah, the second question was, I kind of briefly mentioned earlier, you told me if I'm ready, go ahead and buy those, do some covered calls, but I didn't have enough money in the account. So I was thinking, if I were to buy those covered calls, for example, Sketcher was at about 42, 43. And I know this last week since we spoke, it's gone down. And
what is Sketcher now?
To be exact, it's right there. It's 43.63. What was it last? I don't remember.
0.63. Want to say it's down a point?
I'm sorry?
Let's say it's down a point, which means 1 point.
Okay.
That's $100 for 100 shares. $100 per 100 shares. So when you hear people say stocks down 2 points, stocks down 3 points, that means it's down $300 per 100 shares. Or you can say it's down $1 per share. So if it's down 1 point, a $44 stock becomes 43. A $40 stock becomes 49. For Apple, no big deal because Apple's 172. So that becomes 171. It's basically the same price. Like I said, it's not even a percent. Mm-hmm. If Netflix might be up, 10 points. That's a good day for Netflix, Whereas like you might have a dividend stock like Philip Morris, a good day for Philip Morris is up 1 point because it's a slow mover. It's more steady. If you want steady, look at dividend stocks here. PM. I'm gonna also say WHF, White Horse Financial, and PM Philip Morris. White Horse Financial, WHF. Dividend stocks, 2 stocks at dividend stocks. I'm gonna put here steady, STEADY. And then we'll put technology. And I'll put volatile. Okay. Mm-hmm. Technology volatile, I'm going to put AMD, Advanced Micro Devices. I'm going to put NVIDIA, NVDA. NVIDIA. They're both technology. They both do computers. So dividend stocks are steady. They don't move like crazy. These technology stocks are like, they move like a roller coaster. I gave you 4 stocks right now that are all good. I have all these in my personal account. But there's a difference. The technology is going to be volatile. You're going to see it go up and down. But dividends are going to be more stable, more steady, but you don't get the same return. So it's a matter of volatility versus return, in a sense, volatility versus stability. The stable stocks aren't going to return as much. The volatile stocks, the idea is they'll return more, but they can also be down more. Does that make sense?
Yes.
Okay. So if you get, so let's look at schedules, okay? 43 63. Can we look at, so we're in January. So now we're going to write the February cover call, right? Let's look at February monthly. Let's look at 45.
February, what day? 21st, 28th? Oh, I'm sorry, February, is that right?
It should be always the monthly. We don't do the weeklies.
Okay, 13 days.
So 21st. It's
February
the third
21st?
Friday. It's the third Friday.
Okay, they got February 4th, 20 days, but.
So what you want to do is identify, well, first of all, we're looking at the option chain. And like I said, the option chain is your paycheck because it tells you exactly how much you're going to get right in the cover call, whatever strike you put, whatever month you're on. Also the puts, how much you get for the puts. In this case, we're going to do the calls today, but we'll get to the puts later on in the chapters. So Skechers SKX, buy 100 shares at 43.63. We're going to spend $4,363. Follow me?
Yes.
Okay, it's 100 shares. We're going to write or sell -1 CC February. Let's look at the 45. Let's see what it pays. Can we? The monthly, not the weekly.
The monthly. I guess I'll change this to volume strike strategy. Weekly. Oh, weekly off.
I don't want you to put them off because I want you to see them, but I don't want you to click on them.
It just gives you weekly on or off. Doesn't say monthly, but.
Right. The thing about these tools we have is you have to get comfortable. You have to learn how to use them and work with them. So I want you to practice. Go on your app, on your phone, also on your computer, and look around for these option chains. You know how to pull up the option chain because you click on options, but now you have to be able to read the option chain, which is we're looking only at February. We're looking only at the monthly, which is not the weeklies. The monthly, if you need to know, it's always the third Friday. So if I go on my calendar, you hear me?
Yes.
I'm gonna go to February 4th, 11th, the 18th. So it'd be the 18th. Okay, February 18th. That's the option chain that we're gonna look at.
Okay, I see it. So February 18th.
Now give me the bid and ask.
February 18th at there's a last at what 45 or 43 then the strike price. The bid and ask for what strike price?
45.
45?
Yeah.
The bid is $2 and the ask is $2.15.
Okay, that's a nice tight spread, 15 cents. Okay. Skechers is like on the border of being a great company. So it's not like ideal, but it's good. Okay. it's probably the lowest price good stock you'll find, you know.
Okay.
And I say that because, you know, even though I trade a core 10, I have to look at other stocks also. I have clients, and I have, you know, proteges, you know, and we're looking at Palantir, for example, PLTR. And the stock went from, and it was paying great cover calls. The stock went from 25 to now 16. So how in the hell are we going to make any money? We're getting good money in the cover call, but the stock's going down from 25 to 16. So be very selective. Be a shrewd stock selector when you select your stock. Don't buy crap. Don't buy stocks that are going down over time. Don't listen to the TV. This lady Katie Woods is, you know, she's all over Palantir, but the stock's going down. So what does that mean? You know, people are selling. Okay, so back up Skechers. 2 by 215, perfect, right? So now what that means is we're going to collect $2 per share, right? The cover call for the strike price of 45 for February. That means we're going to get $200 deposited into our account the moment we click sell one cover call or write one cover call. Now, if we go $200 divided by 43.63, which is our investment, or we can go 2 divided by share price of 43.63. What's the percent return on that?
Let's see. 2, 43. 4.58%.
4.58%. Perfect. Now that means that's your return. Now, there's few places you can get 4.58% return in a month, in 5 weeks. The stock market is one of them. Okay. However, we have the responsibility to stay in that position until expiration, for one, and meaning that we can't just take the money and run. We have to stay in there. Okay. And staying in there means we have to hold the stock, and that means that if stock goes down, guess what? We're gonna lose money on the share price, right? So we're gonna get this $2, but we're gonna go up and down in the share price. Okay. We can only go up to 45. So we can get, in this case, $1.37 of share growth, which is $137. We're open to that. That's a potential. Okay. And on the downside, our downside is basically unlimited. So if the stock goes down, we're gonna lose money, whatever it goes down. But we're capped at the 45. So in a sense, we're getting $2 in advance as a premium agreed to sell our shares at 45 in February. But the problem is we're capped at 45, but we have no cap on the bottom. So that's the risk. Okay. Now, why does that make sense? For 2 reasons. One, we're in a good stock. It's Skechers. We know about the stock. We know it serves 150 countries. We know that it has real employees to make a real product, that have a real profit, that have real jobs, to have a real company doing real business. Okay. And you know that the stock over time does well, it goes up. We know it makes profit, has a PE, has volume. See, now we're talking about all of our stock selection. Has a 10-year chart, it's been trading for more than 10 years, has a PE, means profit, has volume. They don't pay a dividend, they don't have that. They don't, let's look at stock splits. When we're ready, we're gonna go into criteria, okay? The criteria, we're gonna look at stock splits. Number 6, stock splits. So here, I have to write this down. Stock split history.com.
Was it
stock split history.com. Go to the website, put in your stock. Now, there's other, websites that tell you stock splits, but that's my favorite. Stocksplithistory.com. Put in Skechers SKX. It'll tell you if and when they've had stock splits.
You want me to check it out?
No, don't check it now. Like if you look at like Nike, Starbucks, these great companies that have done great returns, they've all had stock splits. That's one of the criteria, is that stock splits. I want you to do that on your own time and then tell me what you get.
Okay.
Apple had a 4-for-1 stock split last year. Tesla had a 5-for-1. Netflix had a 7-for-1 2 years ago. So those are even greater splits than 2-for-1. These are even more exponential, splits, which are better. Because they're saying that the stock went up so high. What is a stock split? The stock went up so high for so long that the board of directors sits down and decides, you know what? Would it bring our price down, let's say from 600 to 300, or from 200 to 100, or from 1,000 to whatever? If it's a 5-for-1, then it's 1,000 to 200. That's what happened with Tesla. If it's a 2-for-1, there's 1,000 to 500. But they'll multiply those shares also. So the day of the split, there's no advantage or disadvantage in the share price or the value, because if they double the shares, they'll have the price. If they triple the shares, they'll cut the price in 1/3. So you're even Steven, right? Mm-hmm. But what happens, Ivan, here's the magic. When you have a stock split, those investors who love the stock see the lower price. It's perceived as more affordable. They can buy more shares. And they race into that stock and buy the stock. And guess what? Over time, the stock goes right back up to what it was before the split. And if it's a 2-for-1, it goes from 100 to 50. And then those investors get back in at 50. It's a better price. It's more attractive. What happens? That price goes right back up to 100, and you doubled your money. That's why it works. That's why it's a good thing. So it's not only an accounting trick. It's actually something really happening. Most stocks can never do a proper stock split. You're looking at the cream of the crop, okay? Also, reverse splits don't count. Avoid reverse splits. If reverse splits when the stock has gone so down for so long and it's so low that the board of directors says, hey, we want to live our glory days. Remember when the stock was $50, now it's $5? Well, we're going to split it back to 50 so it looks more attractive. It's like reverse psychology, but in this case, they're trying to give like a facelift, So don't do reverse splits. Avoid reverse splits, but the forward splits, those are the ones you want to buy. Go ahead.
So reverse split is if you have 100 stocks, now all of a sudden you have 50 stocks, but they're worth twice as much.
Yeah, reverse goes from 5 to 50, which is 10, which is 1 for 10. Proper splits will go from 100 to 50, 2 for 1. 2 shares for 1 share. A reverse split goes from 5 to 50, 10 shares, 1 share for 10, or a 1 share for 2. Follow me? Normally it's 2 for 1 and 1 for 2. Just put it down. 2 for 1 is a forward classic. 1 for 2 is a reverse classic. Avoid. And then 2 for 1 classic. Forward split buy. Buy. See, that's why my course is good, because nobody will tell you this. Will tell you to buy a stock that's going to split, or it's beneficial to have a stock that's going to do a forward split, and a reverse is on the other way. I just know from experience, man. You won't get that in any definition. That's from experience. Okay.
I didn't know that reverse splits.
Yeah, reverse splits aren't as common, but they're to be avoided. Yeah. If your company's going to have a reverse split, I would just sell it. I would just get out when I can. That's me. I'm not a value investor. I invest in favored stocks. We go by what's favored in the market. Okay. Back on the cover call. Okay. So now we have sketchers. We know how we can put 4,300, get 100 shares, right? The 45 cover call, get $200 or $2 a share, which is what percent?
4.58.
Now write this down, times 10, which means we'll do this 10 times for the year.
Okay.
I say that because you could do 12 cover calls, but it becomes difficult because you're dealing with time frame, and I want to make sure you do at least 10, ideally 10. You know, you can do 9. Like for example, today, if we do it for February, it's actually 5 weeks because we're doing it early. Because it's only the 16th. It's gonna be the 17th on Monday. So in that case, it's 5 weeks. That's why I just say plan on doing 10 cover calls on your favorite stock for the year, because that's very doable, it's repeatable, it's easy. And anybody, you can mess up and still do it good. So that's why I say 10. And in this case, what I'm looking at is to get 2 points times 10. I'm gonna get 20 points income on this position, which is also $2,000 for the year. That's what I'm looking at. That's what I'm teaching you how to do, Ivan.
Okay.
And take a good stock on your core 10 list. Make sure it has good cover calls. Has to have good volume. Don't do a stock with no volume. I'm gonna save you a lot of heartache. I don't care if you love it. I don't care if you're married to it. You can buy the product, but don't buy the shares unless it's in your core 10, unless it's on selected by your core 10 stock selection. Okay.
Okay.
Okay. Now, how much money are we gonna make on Skechers after 1 year? Tell me.
$2,000.
Right, and that's almost half of your investment.
Mm-hmm.
Because you invested $4,800, so it's like we're getting money back, right? So if we're gonna make 2 points per month on the cover call, or per cover call rather, how many cover calls will it take to pay for your home investment?
20 to 22 cover calls.
Yes, because that'll be 44 points. 22 cover calls will be 44 points. See, you have a brain. I like that, because some of these people that I have to teach them math, and it just takes so much longer, you know? So you are doing very well, my friend. I appreciate you.
Thank
You know
you.
how to do math in your head, and that's gonna make it always easier, okay? So you're looking at basically to have your investment paid for in 22 cover calls. Now, it's not gonna be exactly that, because sometimes the cover call will go down to 150, it'll go up to 215. So it's not gonna be exactly that, but the idea is you're doing something, you're getting money, you have an investment, and not only are you holding the shares, but you're getting the money back every month, every cover call. And that's why you have an advantage over the share of the stock investor that doesn't do cover calls, because they're just holding the stock, hoping to go to the moon. They're not paying bills, they're not selling shares. What you're doing, you're technically trading on cover call. It's technically trading because you're getting like siphons this money every month by writing, or that's considered a trade, writing a cover call. So don't say buy cover calls. You don't buy a cover call. You buy the shares. You write the cover call. You sell the cover call. So that's the right terminology. You're buying the shares. You're writing a cover call, or you're selling a cover call. I like to say writing. There's a saying. I told you that in the market, there's a saying to marry a specialist. There's also a saying, always writing options. Which means you're making money off your shares. You have a lot of shares. We're bringing them, just like you have an apartment owner. They own the apartment. There's 9 units. They rent each unit for $2,000 a month, X dollars a month. So now we have the shares. We have, let's say, 900 shares. We sell the cover call every month. We get money, just like that apartment owner. Okay.
So all this is called under options. You're writing options.
Yes. So we buy the stock, we write the option. Now, the other side of that is people who buy the options. Most people who buy options lose money. Options are a long shot, okay? Because they're buying your option for $2. You have the Skechers shares. You create the option, you sell it to the market for $2. Someone buys it from you. They take that $2 and they hope the Skechers goes to 50, goes to 60. And if it does, their $2 goes like 10 times, okay, or 5 times.
Okay.
But if it doesn't do that, it goes to zero and they lose all their investment. They lose all the money they put up. But for you who sold the option, you can't lose money because you already sold it. That's the
Right.
value. So you have one guy on one side, we're only making a little bit of money, 4% a month, okay, $200. But our money is steady, our money is consistent. On the other side, you're looking for someone who pays you that money, who buys the option buyers, who are taking all the risk, by the way. They're hoping that stock jumps, and if it does, their option goes up twofold, fivefold, like I said. But if it doesn't go up like that, it's going to go to zero. They're going to lose the whole position. And you're going to walk away with that consistent monthly money. And that's why, pay attention, running cover calls is better than buying calls because you're getting consistent money every month. And this is what side of the market we're on. We're on the side of selling options, not buying. Okay.
Got it. I have a friend that buys options. He's telling me, okay. Got it.
Yeah, he's taking a big risk because when I said ideally the option expires worthless, your friends are going to lose all that money they put up. Every sentiment is going to go to zero. It expires worthless, which means basically if Skechers, we go out 1 month to February, third week, and Skechers is still $43, $44, you've collected $200 and your option friend has collected zero because they've spent $200. Your option has expired worthless. The only way the option is going to expire in the money is if it goes to 45 and then higher. Let's say 46, their option is worth $1 at 46 because that's real money in the money is $1. If the stock is 47, their option is $2, which means they got their money back. Okay, broke even. If Skechers goes to 48, their option is worth $3, which means they made 1/3. They made 33%. They went from a $2 option to a $3 option. In our case, we're still better off because we're going to get the $2 up front. We get the 163 share growth. I'm sorry, the 137 share growth because we're going to sell at 45. We bought at 43.63. We're going to get the movement of the stock going from 43.63 to 45, which is $1.37. Follow me? Add that to the $2 for the premium. That's $3.37. We're going to get $337, which is great. And your friend at 48, Twitter 48, is going to get $300 out. So we've made $337, and they've only made $100.
And his risk is much bigger.
I think.
Yeah.
See, they're gonna prove you wrong when the stock shoots to 50 one day, 60 one day. The thing is that won't happen every month, Ivan. We're gonna get our cover call every month.
Yeah.
That's why we're better off. Okay.
Yes. Okay. So this is really good. So I'm looking at February 18th for Skechers. And we decided to go with $45 strike, and that's $2 bid. Now, if we want to play it low, so what that means that if February 18th, Skechers does not go to $45, our option is right.
We keep our shares,
and nothing happens.
Nothing. We keep our shares. We keep the $20. We do it again for February, March, April, May.
Now it's to me it seems like it would more likely go up maybe $1, say $44 strike price, but on that the bid is higher at 2.4. So does that mean?
So we can agree. Let me help you out. We can agree to do the 44 strike. Okay, so let's do the math on that.
Okay.
240. 240.
So strike 44 is $2.40. Correct.
So put 240 divided by 43.63. What's our return?
43.63. Okay, let's see. 2.4 divided by 43.63. It's 5.5.
5.5% return. Wow. Now times higher. 10 is 55% a month. Okay.
Why is that higher when it's more likely 44 to 45?
Okay, so here's the thing. If we agree to sell at 44, we're gonna get $240 per share, $240, 5.5% return. Here's the thing. Since we're going to sell at 44, we can't get the share growth to 45. We only get the share growth to 44. So in this case, we're going to get maximum of 240. Remember we made 337?
Yeah, we lose out on the share growth. Got
Here
it.
we're going to make 240 plus only 37 cents share growth. We sell at 44. So we're going to make 273 maximum. That's why.
We're
making less maximum, but more upfront. Make sense?
Yes. Good. Okay. Yes, that does make sense.
Now you can try to say, well, I just want that money. I want 240, so I'm going to sell it at 43. But you're going to be a little bit sorry if the stock goes, let's say, to 47. Then you get sold out at 44. You have to buy it back higher. Then you'll be right to 50 for the next month. So it's just a matter of a balancing act. I'm not going to tell you can't. I'm not going to say you can't write the 44, but let me tell you about the sweet spot. This is something we just coined recently. Sweet spot.
I love it.
The sweet spot is when you match up the premium, which is $2 or $2.40, with the share growth potential. Okay. Mm-hmm. So back when we had the 43.63, the sweet spot there, since we have 137 share growth, SG, the sweet spot would be 137 premium, but they're paying $2 premium. So we're looking for an option that has the same premium to the share growth. So if we know the share price is 137, the share growth is 137, and then on this this other one you have it's only It's only 37 cents on the 44. So the thing is you want to get the premium to equal the share growth, and that's called the sweet spot. And that's like a natural positive. It's a natural. I would say aggressive. It's aggressive, but it's a very positive outlook on the stock, and also it's a very positive outlook on the trade. So what we're doing, we're allowing for share growth. Ivan. So here's write this down. Allow for share growth. Because over time, we know you have a good stock. We know it's in our core 10. We know we're comfortable. We know what the stock's going to do. We know how steady or how not steady it is. We know what premium we're getting. We know what we're going to look like after the end of the year. We know when it's going to be a cash cow. Okay, so allow for some share growth because that stock will tend to go up. It won't tend to, if it just keeps going sideways, which means it doesn't go up or down. Eventually, that premium will deteriorate. Will get lower and lower. So we do want to get some action going up. And if you don't if you don't give share growth, what'll happen is you'll ideally, I mean, in theory, you'll get less return because your stock needs to go up over time, not just go sideways. So while you might think that the 240 is better, it's not because it doesn't allow for share growth. So
right.
One, always allow for share growth. Two, try to find the sweet spot where you have the premium, which is in this case $2, is equal to the share growth. So the closest one we can get, I think, is to write the 45. That way we get 137 share growth. Here, write this down.
Okay.
137 share growth. And we get $2 premium. Ideally, they're both 2 and 2, or 170 and 170. But I don't think you can get that in this case. You have to get the closest one.
Mm-hmm.
You understand?
Yeah. So I'm also looking at the strike price. The higher it goes, like if it goes up to $48, I get the benefit of the share growth, but my bid is only $1.05.
Yeah. So if you can appreciate that your stock can go up higher, what you can do is you can go higher share growth. So don't do 48, but let's just do. Can we do 46? Is there 46?
Yeah, there is. Yeah, I'm just.
So what's 46? Let's do the 46.
Well, there's a oh, that's a change. Okay, why is there a negative? What does a change mean there?
Don't worry about that. Look at the 46 and give me the bid ask.
Bid is 165. Ask is 180.
Okay, here's what we can do. We can write the 46. Okay.
46.
So
Okay.
we're looking at 3 different cover calls. Okay.
Uh-huh.
The value right now 46. We look at 165. So we get $165. Okay.
Uh-huh.
Okay. Now if we divide 1.65, divide that by 43.63, which is the price of the stock. What do we get?
163. What? 1.65 divided by
43.63.
0.63 gives you 37.8. No, 3.78%.
3.37.
3.78.
I'm sorry, there's sirens going off over here. So what's happening? We're getting less percent return, 3.78, which is still good, still great return. And
Yeah.
here's the thing: we get to enjoy the share growth should the stock go up to 48. So if we look at 43.63, in this case 46, that is how much potential share growth?
That's a $4.37. $4.37.
It's 237. We're going to 46.
Oh, I'm sorry, 46. I'm sorry. 46.
Two,
That's right. That's right. I went to 48. Okay.
yeah,
237.
I goofed. I said 40. That's my fault. So
No worries.
let's compare. Okay, we're gonna get 165 share growth. I'm sorry, 165 premium
Mhm.
and 237 share growth. Okay.
That is 2.
165. I'm gonna add these together. What is
$4.02.
402?
Uh-huh. 4.02.
So the maximum gain was 337 on the 45. Remember?
45 maximum gain was 337. Yes. Uh-huh.
But on the 46 cover call, the maximum gain is 402 or $402.
Mm-hmm.
So here's the thing.
Because you have 100 shares.
Right. So you're giving up more money to for a chance to get higher share growth. So it's a balancing act. There's a saying, a bird in the hand is worth 2 in the bush. What does that mean?
That means it's a bird in your hand. It's guaranteed. There's no risk versus 2.
Right. What it means is, if
You
you have
have
one
that
for sure, it's better, or at least as good as having 2 in the bush. So you don't have those yet.
Right.
So, are you willing to take 165 a month for a possibility at 40 at 237 share growth, or do you want to take $2 a month for the possibility of 137 share growth, or do you want to take 240 for only 37 cent share growth? And if it's 240 plus 37 is 277. So we're gonna go for 277 maximum, 337 maximum, so 402 maximum. You decide. But here's the thing: the share growth is never guaranteed. It's never for sure. It's just a possibility. It's a potential. But the premium, that's gonna pay your bills. So you gotta pay a mortgage, and you have, let's say you have, I don't know, a couple $100,000 account. You want to pay a mortgage? You just, like I said, it's your paycheck. You just pick the one you want. You know, it doesn't matter. I pretend I'm working.
Right.
Here, let's do it with. Let's just do that real quick. Let's go Netflix. Can we go Netflix?
Sure.
Pull up Netflix.
Hey,
Give
Eric,
us the share
this is
price.
getting kind of fun.
Good.
All right,
I
so
like that because you're literally, I'm teaching you how to apply this in real life. So Netflix is how much?
You want me to put Netflix, right? Let me look it up
price.
live.
And we're gonna look at February options.
All right. What's Netflix?
NFLX.
NFLX. Netflix. Hey, there's a question. It says Netflix ORDSHS. What is that? ORDS. What does that mean?
I don't know, but if you can, don't click on that one.
Oh wait, that's the only one.
I think that's the exchange. You want to show it to me? I think that's the exchange. But NFLX.
I'm sorry. Hold on. They all of them have the OR. I always want to. I never know.
Mine don't.
Really? And who's Netflix again?
I'm gonna put my app right now since I have you on the phone.
Okay.
We're almost gonna wrap. Okay.
All right. What's the tick for Netflix again?
NFLX.
NFLX. Netflix. Okay.
Nancy, Larry, Frank, X-ray.
Okay, hold on.
Okay.
Oh, here's NFLX 5. Oh shoot, hold
So we're gonna look at February. Okay.
on.
Now it's 525.69, right?
Hold on a second. I lost it. Hold on.
569, 525 and 69 cents. Okay. Follow me.
I lost my computer. Hang on a second.
Nancy, Frank, Larry, X-ray.
Okay, 525.69. Yes, I've got it.
Now, let's do a goal. 200 shares. Okay.
Log in to find and filter single. So,
Just follow me. Follow me for a second.
okay. All right.
How much does 200 shares cost you?
200 shares.
Yeah.
So times up by 200. Let's see, 525.69.
You can't do it in your head.
I get it. It's 1,000.
Not 1,000.
No, it's 105,000.
Oh, okay.
138.
105K. Okay, 105K. K means 1,000. Follow me. Follow. Fair enough. They're 100K. They'll do a Netflix cover call. They'll do 2 contracts. Am I going too fast for you?
No, I'm just trying to log back in. Sorry. I know you told me just.
And now we're in January, so we're gonna write February. In this case, it's 5 weeks, but that's fine. We get a little less. If it's 3 weeks, get a little more if it's 5 weeks. Okay. I would say the sweet spot's gonna be around 540 cc. So I'm gonna pull up the 540, and you can follow along with me. Options February 18th.
February 18th. Okay, 540. Okay.
540.
Okay.
I get 1990 by 2060.
By
bid ask. Okay. 1990 by 2060. Can we just round it up to 2,000? That's $2,000, man.
Sure.
You're getting $2,000 for the cover call. Now, do you want me to wait for you to pull up the option change for Netflix? It should say 19.90.
Yeah, I have it. Can we
20.60.
Can we not round it? Is that okay? If we don't round it?
Yeah, we can do 1990. Yeah, we don't have to round it.
Okay.
So now that means we're gonna get $19.90 per share times $200. 200 shares.
200 shares.
How much?
So is it 398,200?
39.80, man. 39.82. That's $3,980.
Yes, 3,980.
Okay. So that's your income. Okay. If your mortgage is like 3,000 or 4,000,
that'll pay the mortgage.
Paid.
So I need to come up with 105,000 by the option.
Now, you get some share go, the 540. So you can make money between today's price, 525 to 540. So you can actually make another 15 points of share go, 15 points. That's the potential. It's not guaranteed. It may not happen. It might happen. Netflix has gone down a little bit lately, so it may just shoot up, may shoot right back up. And here's the thing: this is like a technology stock. It's a roller coaster. So Netflix will go up and down a lot. So while you're thinking you're getting 2,000 a month, maybe it's not really that, because if the stock goes down 50 points and you're only getting 20 points, you're really actually at a loss of 30 points. But the thing is, that's a share growth. You can still get the premium. You can keep the shares, hold on to your 200 shares, write the cover call, but you have to endure the ups and downs of the share price like this. And you know that your investment's going down when the stock goes down. It's going up when the stock goes up. And sometimes what you have to do is you have to write the lower cover call because your shares are down. For example, let's say you buy it at 600. You want the cover call for 20, which is great. So you pay a mortgage at month 1. Month 2, the stock's down to 525. So now we're down 75 points, which just happened actually. That just happened. So now what I want you to do, I still want you to write the 540 cover call. You're going to take a loss in your share price because you buy that 600. We're going to agree to sell at 540. That's happening when the stock is 525. So technically, you're going to have a 60-point share loss if the stock sells. If it goes up past 540 by February, you're going to technically have a loss of 60 points or $6,000. Okay, but you got a cover call last month. That's 2,000. You got a cover call this month. That's 2,000. That's 4,000. So technically, you're only out 2,000. Okay, but here's the thing. That's not going to happen. Like I said, that's not going to happen every month, Ivan.
Mm-hmm.
But you're going to get the cover call every month. So you can rest assured, never say assured. You're going to plan, no guarantee. You're going to plan on 2,000 a month times 10. You're going to plan on $20,000 in the stock. Okay, you could lose some money on the share growth. I'll just put it out there. If your average price is 600. And now you're trading it when it's 500, maybe you'll lose whatever it is. But still, you have gotten that deposit in your account. You've gotten that premium every time you wrote the cover call. So even though your shares have gone down some, which case happened last couple months, your mortgage is still paid, Ivan. Okay?
Mm-hmm.
And then the theory behind this is year 1, year 2, year 3. If we do this for 3 years and we do get the premium, which we know how to do that, of 20,000 a month, I'm sorry, 2,000 a month, 20,000 a year, we're making how much after 2 years?
40,000.
And then after 3 years?
60.
Right, after 3 years, you made 60,000. What has that paid for if you compare that money to your investment?
That's your cash cow.
It's your cash cow. There, he's learning. He's learning. You're star.
Just like 22 months for the.
I don't want to explode your brain.
race.
I want you to let's wrap up. Send me some homework. Send me some nice rewritten notes. Get some questions for next week. We didn't do the cover call. We didn't do the last stock selection. Let me just give it to you.
Okay. There's 7, 8, 9, 10.
6 is stock splits. 7 is market cap. Market cap needs to be between 15 to 25 billion.
25 billion?
Yes.
Oh,
15
in
to
dollars.
25 B.
B, okay.
Yeah. Number 8 is share price.
Share price?
Just put $100 to $400.
Okay.
Share price. Number 9 is a new high. Here's some reverse psychology for you. Be willing to buy a stock at a new high, Ivan. New high, buy a stock at a new high. Number 9. Number 10, can it double? Can it double means you look at the 3 to 5 year chart and you look to see if the stock doubled in price in the 3 and 5 year chart. And if it did, it could do it again. So you're looking for stocks that have doubled in the last 3 to 5 years. These are stocks in favor. A lot of them are technology, but some of them are not technology. And that's your 10th criteria to stock selection.
Got it. Quick question on the market caps, the 15 to 20 billion. That's how much the whole company is worth, all the shares combined.
It says there in your information market cap. Okay,
because I know one of my friends has a exponential fitness, and he said he kept something like 75 to 80% in house. He only sold 20%.
You got to wrap.
Okay, thank you.
Thank you, Ivan.
Bye bye.
Thank you. All right.